Hey, welcome to the exchange. Let's look at a scenario where Jerome Powell stops raising rates this summer and why it might happen. So right now we're in a rate tightening cycle, which basically means we're raising rates, every meeting after meeting, month over month, etc. And our target goal, was, as Jerome Powell mentioned last meeting, was 2.5 to 3%, which we're still a long ways off from that too. We have to ask ourselves, why would he stop? Why would they change? I really see three different scenarios there. Number one, there's an economic shock where all of a sudden something happens, like a bank blows up or a real estate company blows up. Something happens where it's like, hey, this is bad. The actual economy is failing. Number two, he gets actual data of deflation or basically disinflation, where inflation starts coming down quite a bit, where he can be like, hey, we can slow it down quite a bit or stop potentially. And number three, I see there is basically an unemployment surge, where all of a sudden something happens where unemployment all of a sudden just spikes up for some reason, and I see everyone freaks out. So I pulled up this graph here, and this is the U.S. ISM manufacturing PMI, which ISM is Institute of Supply Management. And really all this tracks is new orders in the red bar and customer inventories on the bottom bar in the blue. So basically, as inventories get low, new orders spike, and as inventories get high, new orders shrink. So basically, it's like inverse each other typically. Now they will cross in periods of like basic economic distress or financial crisis, etc. So like you saw, hey, COVID first hit, they crossed. Financial crisis, they crossed, .com crash, they crossed basically. But generally, they should be pretty level. Usually you see the blue line roughly in about the mid 40s, like 45 or so. You see the red line usually hovering right around 60. And these are index levels and not actual true benchmarks. Basically, it's just like what they do is they poll manufacturers and customers, every month basically, and say, hey, how's your inventories, how's your new orders, etc. What's going on? Basically, that way they can track kind of overall trends and see what's going on. Really behind the scenes. But as you can see here, post-COVID, you see new orders absolutely spike. So it's looking like second half of 2020, it's been around 65, almost 70 in that ballpark, really for the past year and a half. And you see inventories down here, it's dropped dramatically, which makes sense. Hey, you hear those supply chain issues all across the board. No one has anything in stock. They can't get anything in stock, et cetera. They're having major issues. But it's been roughly in the low 30s, hitting the 20s actually too a little bit last year too. But as you can see, in the past 4 or 5 months, there's been massive spikes in inventories in customers and massive drops in new order being placed to the actual manufacturer himself, which is very, very interesting. So what I pull up here is a graph of CPI, which is Consumer Price Index, basically a measure of inflation that we generally use. But as you can see here, it's been roughly around 2% mark. For most of the 2010s, obviously you saw during like the basic great financial crisis, it dropped quite a bit there. But really, it broke out of the normal range in about, looks like roughly April 2021, went from basically 2.6 to roughly 4.2% last year. And it's been just on the up and up ever since. It's been a lot of headline fears of inflation. And, you look here, like March, 8.5%. Just massive swing. But the swing really began in April, May, kind of 2021. You saw where it really started spiking well above the norms for the first of 2010s. So what's interesting though, if you've got the same time period, April 2021, customer inventory levels, basically what happens is you can basically get the very bottom of the kind of that tranche where it's just bouncing around the very bottom. That's basically the trough of basically customer inventories. You do the same thing up at the actual new orders. You see right there, April 2021. It's not quite as bad. It's a little bit forward leaning, but you see the customer inventories. That's really bottomed out, which really shows you, hey, like those low inventories, historically low inventories, and all of a sudden now prices are going up dramatically. But now what we're seeing too in the last looks like 3 or 4 months is the opposite happening. So really what we're seeing right now is customer inventories actually increasing month over month while new orders are dropping drastically. These are huge spikes. Look at these spikes, just the slope of these spikes. They are much, much faster than normal. Obviously coming out of the GFC is a little bit different there too. But these are massive moves by inventories and new orders overall. And the real question is, hey, as inventories increase and new orders drop, what happens to prices? You can take a guess right there, but they're probably going to drop. So another thing to remember too is that's only the supply side of the equation, also a demand side too. So if supply is increasing and also we have a demand shock, well, basically right now we have 8% inflation, roughly 8%. Wages have increased about 5.5%. So it's basically a negative 2.5% drag on the actual real economy itself too. Consumer discretionary income, it is getting contracted right now. It is shrinking with gas being so high, rent going up, etc. Your actual money you can pay to buy coffee or buy certain products, etc. That money is shrinking very, very fast. So we have to ask ourselves right now is what would happen if we basically have a demand massive decrease and supply massive increase. The deflation cycle, and this can get very violent very fast later this summer. That's why I always see hey, Jerome Powell raising rates, and looking at July, August timeframe. You might be in for a huge shock. We're also raising rates into basically a recessionary economy, and then from there, it's hey, what happens? At that point, you have two choices: either hold what you got and keep the rates high, or really it's drop rates and print. That's really his only two options, and either one are not really good. But it's one of those things where it's going to be interesting, kind of fork in the road for the U.S. economy, and kind of see where we go during the second half of this year. So I do want to leave on some good news. So you look at this like massive multi-month basically drop, month over month, where it's pretty sharp decline overall, almost like a heavy end roller coaster. Really, what I compare it to honestly is 1994. If you look at 1994, it's very very similar. High around 65, and it drops very sharply month after month after month. And looking at like what actually happened in the real economy in that time period. But I found this article. I'm gonna pull up real fast. So this article's from the LA Times from January 1st, 1995, and it's titled, Hey, 1994-1995, Review and Outlook, Thrills, Chills, and the Real Economy Enters the Center Ring. In 1994, the best U.S. economic growth in perhaps 10 years begot the worst stock market since 1990 and the worst bond market in more than 60 years. Does sound very familiar? Just like 2022, I mean, we're in the exact same scenario in a lot of ways. A little wonder Wall Street so fears what the economy might do for an encore in 1995. Seeming paradox, bullish times for businesses and workers equating it with bearish times for financial markets, aka today. Remains the focus of investor debate and concern worldwide as a new year dawns. It's easy to blame the Federal Reserve's boredom for 1994's lousy markets, of course. The central bank tightened credit for the first time since 1989, seeking to rein in the economy and crush inflationary pressures before they developed. I mean, it is a very, very similar situation we're at right now today. I mean, it's one of those things where history doesn't repeat, but it definitely rhymes. And like we're in a situation right now where it's very similar to 1994, where hey, we had a huge surge. All of a sudden we're tightening now, where inflationary pressures going on. We're trying to beat back inflation. We got to remember too, is 95 to 99, the rest of that decade, I mean, it was a very, very positive year for stocks and overall just everybody else, the economy in general. We grew very, very, very fast. Now, there was a blip there in 1998 with the Russian devaluation crisis. That was a big crisis too. But overall, I mean, if you're a long-term investor, and pull up a chart right now, the S&P 500, and look at the late 90s, or even 94, I mean, this like actual like contraction, I mean, it's just a speed bump long-term for, I mean, so if you're a long-term investor, it's one of those things where, hey, this might be a time where you can get in cheap and invest for the long term. And all of a sudden, they'll look back to 2021, 2022 and be like, hey, that was no big deal. It was scary in the moment, but long term, just a speed bump in the crisis. Hey, let me know your thoughts on this one. I mean, this is where I see, hey, we won't see the effects of this probably till July and August timeframe, but I mean, this is on the supply side too. I'm really curious what demand will do because we're already starting to see some demand let up a little bit and consumer discretionary incomes, dropping a little bit. People like starting to hoard cash a little bit more potentially. Seeing real estate possibly top out too. I mean, there's a lot of question marks right now in the actual real economy itself. And that's why I literally see this like whole idea of 16, 17 rate hikes or the 3.5, 4% plus federal funds rate. I mean, it's just, I don't think it's likely. I think bonds yields might be topping out, that 3.2% kind of area right now because it's like going higher than that with the data we're going to have pretty soon based on the inventories and everything else. I mean, it's going to get very, very ugly very, very fast where rates might be topping out pretty much, pretty soon. The question is what's going to happen with stocks. But yeah, be sure to sub, like, comment down below, and that's the exchange.